All right, we'll kick it off. Hello, everybody. I'm Jeppe Kirk Bonde, and the most copied popular investor on eToro. And welcome to this quarterly conference call for Q2 23. If you want to use this presentation for anything, please go ahead and read the disclaimer at the bottom of this slide very carefully. So the agenda for this presentation is I'm going to go through my background, then talk about my investment strategy, then go through my portfolio, and then finally go through the many questions that I've received in the past weeks. And then there'll also be an opportunity at the end to ask questions in the chat. So the reason, or one of the reasons that more than 20,000 people are copying my portfolio on eToro is that since 2013, I've had an average annual return on investments over 25%. And that's really better than anyone you could fairly compare with, and also with a very good risk to volatility ratio on par with other top well-diversified equity-focused non-leveraged portfolios. My background is from management consulting. I used to advise large banks and tech companies and companies in many other industries with a focus on valuation. So evaluating what are companies really worth, calculating what their share price should really be. That's really useful in large companies if you want to know what your own company is worth, what other companies you might want to acquire are worth, or what you would be worth if you did this versus doing that. Then, as I was making more money than I was spending from my consulting job, I wanted to invest my money. Then I looked at what my bank had to offer, what my pension fund had to offer, and I was quite unimpressed. Then I decided, okay, I can probably make a better investment portfolio myself with a better diversified portfolio with lower fees and potentially higher returns. And then I started comparing all the different platforms, and I compared them on their website, their app, how many instruments are available, what are the fees like, how is this platform developing over time. And then out of those, eToro came out at the top, and then I started investing on eToro. Then my investments on eToro kept doing very well. And then as a result, people started copying my portfolio on eToro. And then in 2018, I quit consulting to focus only on managing my investments. And then since then, it's continued to go very well. And eventually, I was the most copied investor on eToro with more than 20,000 copiers, copying for more than $50 million US. Now, I don't do everything on my own. I have a great assistant who helps me with analysis and video editing and such. I have a great network of experts that I trust, especially on complex topics. When I invest in something, it must either be something I'm myself an expert in, or I must know someone who is. Otherwise, I can't get to the real core insights fast enough. And there's, of course, a little bit of a bias in the portfolio to industries I've myself worked in as a management consultant, because that, gave me a good sort of level of background knowledge for those industries. I also get really good support from eToro. Whenever I have any questions or concern, they're always really fast to help me. And because I've been, using eToro for so long, I almost know, like, if there's a problem with this, I know who to email, and then it sort of gets fixed. Also, eToro provides some great tools for me, for instance, a network service. So if there's anybody I want to talk to from any kind of company, then I can just write it into the system, and then a meeting will be scheduled. And then when China started cracking down on gaming, I was immediately able to talk to one of the leaders from one of the largest companies in China. Just before this, I just received an email with a list of contacts from OpenAI I can schedule meetings with, and this just helps me to get some extra insights. All these meetings are, of course, recorded for compliance purposes to ensure only publicly available info is discussed. Then I subscribe to the best data tools so that the best data can automatically flow into my models and ensure that anything that can sort of be done in a smart way is done that way. Then finally, I'll highlight my favorite experts, which are my three brothers. One of them, he's the CEO of a marketing company. One of them is an economist with the Danish Ministry of Finance in charge of all of their macroeconomic modeling. And the last one is a computer scientist specialized in AI, now working with effective altruism. So if I have any questions or concerns regarding those areas, then they are my go-to guys. My investment strategy is based on some principles that have been there all along and continue to be here. Firstly, I focus on macroeconomics, so evaluating what kind of growth rates I think different pockets of the global capital markets can each have. Then I focus on mega trends. So these are trends that can, grow by more than 10% per year for more than 10 years or equivalent. I focus on fundamentals. That means really getting a deep understanding of companies. What are their management teams like? What's it like to work there? What is the competition like? What are their products and services like? What are their different strategic options? How do their financial statements look? How much cash do they think they can generate year by year? How will they perform in this scenario? How can they perform in that scenario? And so forth. And that's all with an eye on evaluating and providing a valuation of the company to say, how much is this really worth? And then compare that with the price and invest in companies that are worth a lot more than they cost. Then I focus a lot on the long term. That's the most counterintuitive of these ones, the one most people find the most difficult to understand. Because of course, if you are right in the short term, time and time again, then the long term will take care of itself, because the long term is obviously made up of a long series of short terms. But way too many people focus on the short term and not enough people focus on the long term. And there's sort of, if you want to run your investment portfolio, run a business, or even run your life, you really do get better results in practice if you are able to almost ignore everything that will not matter 10 years from now. That sharpens your analysis, make sure that you put an ample focus on the really important thing and can sort of ignore the noise. There's a great quote by Benjamin Graham, who was the author of the book, The Intelligent Investor, and also the mentor of Warren Buffett. And he said that in the short term, the market is a voting machine, in the long term, a weighing machine. And that effectively means that in the short term, it can be very important what other people think about different stocks. But in the long term, if a company becomes very big and profitable, then it'll probably also have a very high share price or be able to at least deliver very high dividends or something. And if you've invested in that and you own a part of a very big company, then that will probably be very, very nice. And I have the patience to wait for all of the voting to dissipate as noise and for the weighing to really come in and sort of prove me right on my hypothesis for where things would go in the long term. Then I focus on risk management, of course, keeping the risk as low as possible within my risk appetite while having as high returns as possible at that risk appetite level. So that means diversifying across different geographies, business models, and industries. I currently have 59 different investments, and the largest one makes up about 6% of the portfolio. I also hedge against tail risks. So these are risks that are not so likely to materialize, but if they do, then they could have a very outsized impact. And so I want to at least have one asset that could do really well if such a scenario was to occur. Finally, I focus on keeping fees low. I don't do any short selling. I don't use any leverage. I don't invest in any high fee instruments, and I keep a quite low trade frequency. I don't do any day trading, and effectively keeping the fees low is just one more way you can squeeze a bit more profitability out of one's portfolio. Then there are some areas where I generally see great opportunities for investments. I like companies that deliver organic growth. That means that they are selling more products or are able to increase the price of their products by more than the inflation rate. But it does not include companies that are growing through acquisitions. So quite often you can read in the annual report that our company grew by 2% this year. But then, after a bit of analysis, I can say, that's, very fine, but actually that's just because you acquired another company. The core business shrunk by 4%. So it's not very impressive and does not bode well for the future. Some companies are able to acquire companies at a low price and then add a lot of value after the acquisition. And all that value added after the acquisition counts as organic growth. So that's still fine. For the few companies that can do this well, acquisitions are a good thing, but for other companies, they are quite often a value destructive. I like companies that are resilient. That means they can do well across many different scenarios, not just a few, and companies that have strong, sustainable competitive advantages. If they're in the pole position in their industry, they will not be so easily knocked down from that position. And if they're on the way there, there's a clear path for them there. If they just do the things that, where they are unrivaled, then it'll take them to that position of really good defensible profits. I like companies that are profitable, companies that can deliver real value year after year, either in terms of dividends to shareholders or by growing the company. I especially love when companies are able to reinvest into themselves to grow over time. Then I like to invest in companies when they have a new strategy, of course, provided it's a good new strategy. And also I must, trust that there really is a new strategy and it's not just something that's being said. I've certainly experienced reading, big, bold, supposedly new strategies from companies. And after sort of reading all the material available, thought to myself, yeah, that's exactly the same as the old strategy. But there are other times where a company really does new things. They are selling off a part of the business, changing their name, really going in a new direction. And at such a point, you can sometimes be able to, get the value of the new strategy, but only pay the price of the old strategy. Then, if you want to understand companies, it's essential that you also understand products and services, because that's essentially what companies deliver. A classic example of failing at that was when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand, and he said, it doesn't have a keyboard, it's too expensive, business customers won't like it, I'm very comfortable with our position. And he was, of course, proven completely wrong by the success of the iPhone. But that was an example of holding the blockbuster product in your hand and not being able to see that that's the blockbuster product. And yeah, many people have recently made the same mistake with Tesla, and will probably continue to make the same mistake with many other products. If you're a smart shopper who's able to, understand what are the important features in a certain category of products, what's really worth paying more for and what isn't, what, should customers love here and what shouldn't they, then, if you understand products and services to a high degree and you're just able to make good purchases effectively, then that's one piece of the puzzle that you've managed to fit in. And if you are not really good at understanding products and services, then it sort of becomes impossible to actually do good valuations. Finally, I like companies that are mission driven, not just because I sometimes believe in the mission, but because it can be a great way to attract the hardest working, smartest people without overpaying them and, keeping them engaged. There are some companies that are absolute magnets for talent, where some of the smartest, most hardworking people, they just want to work there no matter what. And you can see those companies are just getting lots of interest from the people that can really take companies to the highest levels. And there are other companies where the opposite is the case. Smart, hardworking people just can't wait to get out of there. And even if they, try to make a great salary offer to someone from a competitor, they will not be able to get their best people. They'll get their tier 2 and tier 3 people. And whether a company is in one end of that spectrum or the other may not show up in the financial statements next quarter, but a few years down the line, it certainly will. Then my portfolio on eToro is primarily a stock portfolio. I also have a property that I rent out. Many people that copy me probably have a property themselves they live in and are building a stock portfolio. And this makes very good sense because historically, property and stocks have been the two best performing major asset categories. Bonds have historically been okay. Currently, with high inflation and sort of moderate interest rates, I don't think they're looking that great. Commodities have historically been quite useless, but done a little bit in the past decades. And currencies have historically been terrible. They are currently terrible. And I think they will likely continue to be terrible. So whenever I have a lot of excess cash, I generally like to get it transferred as far left as possible in this chart, ideally into some stocks. Then there are some factors that really drive, the growth of the global economy over the long term. I like to split this into the physical realm, the social realm, and the tech realm. So within the physical realm, it's very important how many trees we have in different places, how much oil and gas is in the ground, how much of the different metals is where. Also, life is important, animals as well as humans, how many people live in which places, how are the demographics changing. The companies that have the right product for the right demographics in the right places, they of course have an advantage. Then the category in which the most value can be destroyed or created the quickest is in the social realm. If you have a piece of paper or some numbers on the screen that prove that you own your house, or maybe a US dollar or a stock or a bond or something like this, this only has value if we all believe it has value. If we stop believing in these documents, words and numbers on screens, then all that value can very quickly dissipate. And these systems can really help us transact with one another, cooperate, and in that cooperation, create an extreme amount of value. But again, that value creation can also stop. Then why does something really have value? Many people intuitively just think a house has value. Of course it has value. It's made of bricks. It's tangible. That obviously has value. But it only has value because we all want to live in houses. if we all suddenly decided we only want to be out in nature and live in tents and nobody wants to be in a house, nobody wants to look at houses, then houses will not have any value anymore. And sometimes there can be something that we don't value that we will in the future value, or that we are slowly growing to value. Sometimes there can be something that's growing at a high percentage rate, but it's coming from a small part of society. But if it continues at that rate, it'll certainly be everywhere and be a very big deal. And if you can get in on a company that's either driving or riding on the wave of one of those movements, then that can be the ground for a lot of value creation. Then finally, there's the realm of technology, especially the foundational changes in, going from the hunter-gatherer society to inventing agriculture, to the industrial revolution, getting the first steam engine, then the internal combustion engine, getting to the electronic era, getting to the internet era, and now, getting to the era of artificial intelligence as potentially the next big foundational technology leap. In addition to those big leaps, there are great growth. Great growth is created through just small incremental innovation day by day in people's homes, as well as in great companies. Some companies are just doing things slightly better every day. And while you don't necessarily notice it with big headlines, over a few years, it can really, really make a big difference. If a company is slowly accelerating away from the competition a few years down the line, it can really, really look completely different. And similarly, if a company is sort of maybe ahead, maybe a leader in an industry, but the competition is just slowly catching up and they're not kind of standing still, then that can also really, really make a difference down the line. Then from these sort of big factors that can drive global growth, we can zoom in on how the world then looks right now. So if you look in the US, the growth rate is quite stagnant, but at least it's positive. Unemployment rates are quite under control. Interest rates are at a very moderate level now, on par with what they've been historically, but inflation is too high, and it's on average expected to continue to be too high. And then if you look at how the market is pricing in inflation, it should over, maybe after a year, maybe a little bit longer, be sort of back to target rates. In the Eurozone, growth is also next to nothing. Unemployment is too high, but it's actually not as high as it was just before COVID, so it's gotten a little bit better. Interest rates are still quite low, and inflation is sort of out of control, and it's not really expected to get that good in the near term. So that's sort of a major issue. In China, there's a lot of growth right now because of it being, taken as a percentage off of a much lower GDP, because there was the massive lockdowns until very recently. So it's sort of a rebound after lockdowns that they're experiencing here. Unemployment isn't too bad. Interest rates are a bit too low, but inflation is under control. In India, growth is good, but it's very unevenly distributed. So a lot of unemployment persists. Interest rates are high and inflation is sort of out of control. And in Brazil, it's looking really, really poor across the spectrum. Then there are some mega trends that I've identified as extra interesting. If a company is driving or riding on the wave of one or more of these mega trends, then it's more likely to be found in my portfolio. So firstly, I like to focus on the nice to haves. When we humans have it all, we like to compete with each other on who can have the best fashion, who can win in various fun games. And ideally, we could have a future where we can spend most of our time on, such joyful activities. But these great activities cannot stand on their own. If you lose the security, then all of these fall away. If you don't have security, then you have very little. Similarly, if you lose your health, then it doesn't matter whether you had great goals or small goals, or whether you were going to do good or evil. You can't do any of it if you don't have your health. The companies that have quite extraordinary profits and growth opportunities in gaming, in fashion, in security, in health are to be found in the portfolio. Finally, there are the enablers and accelerators that can really help us do all of these things better, faster, cheaper. The companies that have delivered the biggest breakthroughs in artificial intelligence over the few years, they are certainly to be found in the portfolio. And also the companies that will deliver the next generation of the most amazing devices. Then when you've found an industry or a group of companies of some kind, you want to get an overview of them. a great way is to look at the multiples. So this is an example of big tech. So Microsoft, Apple, Meta, Alphabet, and Amazon. If we look in the top left corner, we can see that all of them have quite decent profit margins, especially Microsoft. But except for Amazon, they are lagging far behind on this metric. In terms of growth rate, they're all standing a bit still. None of them are having those double-digit growth rates that we were seeing a few years ago, and Apple is even declining a little bit. For the two top charts here, the higher the better, because they're about profitability and growth. But for the two bottom charts, the lower the better, because they're effectively about price. So at the bottom left corner, we can see that for every dollar of profit that Microsoft brings in, we have to invest $29 as investors to get the rights to that dollar of profit. And it's a little bit high, but potentially okay. For Meta, it's a bit lower. But for Amazon, it's a lot more expensive. So we'd only want to pay that much more for Amazon for every dollar of profit if we think they can improve on that profit margin in the future, or maybe sustain or boost their growth or something like that. Otherwise, we wouldn't want to pay that much more. Then if we look at how much we are paying compared to each dollar of revenue they're bringing in, we can see we are paying $12 as investors for every dollar of revenue that Microsoft is bringing in. But they're also getting a lot of profit out of every dollar of revenue. If we look at Amazon, on the other hand, we're only paying $3 for every dollar of revenue, but they're also getting a lot less profit out of each dollar of revenue. So that makes a little bit sense. So that's a way to use the multiples to get an overview of a group of companies. I usually don't look at beautiful charts. Instead, I tend to look at just big data tables. These data tables can either be some that are updated automatically, or they can be some that are updated by myself or an employee based on the subjective numbers. So input can be from the data providers, or subjective insights. So I might say, how much do I like the CEO on a scale from 1 to 10? How good is this website on a scale from 1 to 10, and so forth? So that's subjective, but it's numerical, and so it can be used in my valuation models. I use all of that data to constantly assess how good investments different companies might be, and compare how they fit together risk-wise, and then always keep an eye on what is the best portfolio I could have right now. Is that the portfolio I have? If not, make the changes so that's the best portfolio I have. Now, as I do valuations and do my risk scenarios, that then helps me to make decisions. Those decisions are most often research decisions. So I can see something, it tells me I should maybe try to learn more about this thing. I then learn more about it. Maybe this causes me to see some new risks that in general I want to incorporate into my models. Maybe I find out that there's some new technology I need to learn more about. Then I learn more about that, incorporate it into my models, see what my models then say. That tells me I need to learn more about something else. And then that sort of spins around in a circle until I eventually, get to investment decisions. And that can either be that there's a company I've already invested in, but I want to have even more. Maybe I want to have less. Maybe I want to get rid of it entirely. Maybe I want to add a new asset to the portfolio. And when you then take all of those investment decisions and add them up, then that's my portfolio. If we compare that with the economy of the US, we can see that in the US, it's not just one industry that's delivering all the economic activity. There's economic activity spread across a wide number of industries, and there are great investment opportunities across a wide number of industries. In my portfolio, there are many different industries represented, but there are some that take up a slightly larger proportion than others, especially tech, climate, including green tech and renewables, metals and mining, financial services, and health, including biotech. Then the largest assets in my portfolio now are First Solar and Playa and Microsoft. And you can always see exactly what I have in the portfolio on eToro, in the app, or on the website. That's always available to see. Then that was my presentation here. Now I will go through the questions that I've received in advance of this call. And then after those, I will take questions from the chat. So the first question here. Just a second. What were the main changes to the portfolio this quarter? So there is effectively 3 categories of changes that happen to a portfolio during a period. Firstly, there are the events that happen to the companies in the portfolio. Even if all the prices were to stay the same and you don't buy or sell anything, a portfolio consisting of companies naturally changes over time. Companies hire people, they fire people, they invent new products, they launch new services, they fail at things, they succeed in things. So companies are almost living, breathing entities that are changing over time. And the biggest changes in the portfolio from those terms this quarter are in terms of the companies that have really pushed the limits of what we can do with artificial intelligence, and then how much into what extent other companies have either responded to that or sort of failed to respond, or have maybe shown some indications on what they could potentially do in the future. Then there are the changes in prices. Here, the biggest changes for my portfolio for the quarter were that First Solar and NVIDIA and Meta went up quite a lot, but the mining companies went down quite a lot, and Unity went down a lot as well. And finally, in terms of what I did to the portfolio, I added to my already large positions in Playa and Microsoft. I reduced my relatively large position in Leidos and Centene. I removed Husqvarna and Alteryx completely from the portfolio. And finally, I added a Brookfield Infrastructure. So that was the. How long do you think this growth trend of the last months will last? So I don't think it's a correct way to think about markets in terms of like, now there's a growth period, it'll last for a while, and then it'll be replaced by a down period that'll last for a while. It's sort of a little bit akin to thinking that if you flip a coin and you get one result twice and then one result 3 times, thinking that those are somehow linked. Just because the market went up for a few months doesn't mean it's going to continue to go up. But on the flip side, if markets went down for a few months, doesn't mean that it's naturally going to go down or up as a result of that either. Most people that think in this way have they all have the same problem, which is that they actually never end up investing. And the only thing that changes is their reason for not investing. So if the market has gone up a bit, they think, oh, it's gone up a bit, I should probably not invest now because, it's gone up, maybe it's going to go down after, so they don't invest. At other times, like, oh, the market's gone down a bit, sounds like a dangerous period now, I should probably not invest. So then they never end up investing. If you look through history, stocks have on average gone up by 7% in real terms per year. And if you look at the growth rates and profitability and status of the economy, I think somewhere not at that level, but a bit lower is the most likely outcome. But in any period of time, stocks can easily go up or down by 20%. In 1 year, they can easily double or halve in value. So you sort of have to accept that there are many potential scenarios, and some of them are very bad, some of them are very good, but the weighted average across those scenarios is pretty good. And if you sort of take each period and then the next and then the next and then the next and average it out over all of those, then the final result is quite likely to be very good. There's never been a period of 7 years where markets were overall down. If you had invested right before the financial crisis in 2008, you would have immediately lost half of the investment. But today you would have more than doubled, the value of that one just from the market average. So that's sort of that speaks to the focus on the long term and not using the last few months to think, to evaluate what's going to happen in the next few months. What impact may de-dollarization have on investments in the West? So if you look at the US dollar, it's still has a higher market share of the global currency markets compared to what the size of the US economy would justify. But it's not completely out of proportion. It's close to that, just a little bit higher. Why is it a little bit higher? Well, because many people around the world prefer to use the US dollar. Many central banks keep a reserve of US dollars. And, I've often been to countries where they prefer to receive US dollars compared to their local currency. I had one such experience just very recently in a country where the currency more than halved in the past few years. If you sort of look at what could dethrone the US dollar as the, supreme payment option for people around the world, is it going to be some other currencies joining forces, sort of like when the euro came? That could happen, but one of the big strengths of the US dollar is not that the US dollar is so great. It has all the flaws that we talk about, but it's also that the other currencies have tended to be even worse. So the other currencies would really have to show good monetary policy for a long time before people would really trust them so much. Then, of course, you could say maybe we'd all switch to Bitcoin. Maybe we'd all switch to a completely different currency system. But then in the process of going there, I think there are many other currencies that would be wiped out before the dollar. But overall, that sort of speaks to the idea that this is not I mean, the dollar has declined as a share of global currency markets for many years. So it's sort of, we are de-dollarizing to an extent slowly. But so I guess when people talk about the conservative de-dollarization, it's more sort of could there be like a big outside impact that would do a lot? And I think if we had sort of even a really, really bad case of the dollar becoming, not used outside the US, even then the shock is not that great. So it's sort of unlikely to happen fast. And even if it does happen, the impact is not super big. Who would be hurt the most is the US banks, because when you have, a national currency that a lot of people use, when you expand the money supply, then, you get to create that value of increasing the money supply. The companies and the government that gets to directly benefit from that, they have an amazing value generating machine for themselves, and losing that would be really, really, really detrimental. Then will it be possible to close Novatech positions? So I don't know. For those that don't know Novatech, it's a Russian company, and because it's a Russian company, it's been delisted. There are sanctions imposed. It's not allowed in many countries to buy or sell the share, and it's not possible on eToro now to buy or sell the share. So if you have the share, then you're basically stuck with it. And I'm one of the people stuck with it. It's gone down by 99%. When I originally invested in this company, I assigned a 30% probability that the Russian government would somehow seize the assets of this company, and the investment would be lost. I accepted that risk. That's not what ended up happening, but sort of effectively, to some extent, it is what ended up happening, and that's really unfortunate. Hopefully, there'll be some kind of technical solution in terms of how this stock is handled, and on the wider scale, hopefully there'll be some resolution. We are 30 countries in Europe that are living next to each other, behaving normally. And like, why can't Russia just behave normally like everybody else? Why do they gotta be such a violent, noisy kid disturbing the rest of the class? Hopefully, the counteroffensive will do something with that. Is it good to invest in ETFs on eToro? Yes, I think in general, ETFs is not the best way to invest, but it is a great way to invest. I have 3 ETFs in the portfolio. In general, the ETFs, if you invest, for instance, in the SP 500, then you invest in 500 different US companies in proportion to their market cap. So the bigger ones take up a larger proportion. That means that, you're only getting US stocks, and it'll be skewed towards the big tech companies a lot. And, that's sort of okay and can fill a bit of part of a portfolio, but that does not provide full diversification. And diversification, if you only have one stock in your portfolio, then you might have picked the stock that you think has the highest average return, but you're getting no diversification. If you increase to 10 different stocks from different regions, from different industries and so forth, you're getting a lot of diversification, and you're not reducing the return by that much potentially. If you go from 10 stocks to 100 stocks, you can probably capture the entire benefit, 99.999% of the diversification benefit. And so going from 100 to 500 assets really will not yield you much. And of course, if you go from 100 to 500 assets, but they're all in the US and they're all skewed to tech, you're not even, changing your diversification by any noticeable amount. You also, when you have an ETF, you pay a recurring fee, and there is also a fee because they're constantly rebalancing. So that's why, sort of, instead of buying everything that's in ETF, usually I prefer to pick out the specific companies that I like and then avoid the ones I don't like so much. But aside from that, there are many way worse ways to invest than ETFs. It's a great way, but it's not the best way. What happens if I add funds but do not tick copy open trades? So when you start copying people on eToro, for instance, myself, and when you add funds to increase how much you're copying with, you have the options to tick a little box where it says copy open trades. If it's ticked, that means you're investing in the same assets that I'm currently invested in. When I then sell something, you sell the same. When I then invest in something new, you do the same. And I think that makes good sense for many people in many situations. If instead you don't tick it, then you're only copying new trades with those funds. That means they'll remain as cash and only be used when I make a new trade. And, that potentially might mean that too many funds will be left as cash for too long. So it could potentially be better to have it deployed in the same assets that I'm invested in for as long as I choose to be invested in those assets. So I have some money invested in Apple right now. Maybe I'll continue to have them invested in Apple. And for all that while, you'll be invested in Apple as well then. And then eventually when I decide to say, okay, nobody's using iPhone anymore, Apple's never going to make any profits again, let me get out of Apple. At that time, you'll get out of Apple too and get into whatever else I've found to replace it. How do you see the current valuation of renewables companies? So I think they're really all over the place. In some sort of big sectors, you can see that the valuations sort of follow each other quite a lot. But in here, it's really, there are some companies that have razor thin margins and very small growth prospects, yet are trading at extremely high prices. And those are, of course, not to be found in my portfolio. The three examples mentioned here by the person who asked the question, none of those are to be found in my portfolio. I think if you go through them, solar is the one that I generally find the most attractive. I think wind is decent, hydro is okay. Nuclear, I think currently is really, really overpriced. I love the technology. I think it's a great thing that the world should use a lot more of, but it's really, you're paying a lot of money to get those stocks. And finally, geothermal, I don't really know well enough. I've evaluated some projects, which I didn't really, in the end, consider good investments. My mom is I think she just finished getting a geothermal in her house. So yeah, maybe I can learn something from that, but yeah, I don't really know about geothermal. How can I get alerts when you buy or sell shares? So you cannot do that directly on the eToro platform. You can go in on eToro and change your notification settings, to get either pop-ups in the app or emails or whatnot for different things, but not for when I buy or sell shares. If there is another tool with a terrible name that I almost don't want to say, bullsheet.me, bullsheet.me, and that tool basically integrates with eToro and allows you to look at your portfolio in some different ways and also get alerts of this type. So yeah, some people like to use this tool. What is the minimum to copy open trades? So the minimum should generally be $600. eToro will not execute trades smaller than $1. So if you're copying with a very small amount, say you're copying with $100 and I want to make a trade for 0.5% of my portfolio, then you would basically be trying to attempt to open a position for $0.50, and yeah, eToro will not open trades for less than $1. So copying by more than $600 ensures that you get all trades, including the smallest ones. And that also goes when adding funds. When is a good time to top up? So firstly, I don't think that people should be trying to time the market, think like, oh, now is a good time to add funds. Maybe the market's going to go up. Now I'm going to try to add funds. You'll be spending a lot of time trying to, you're effectively adding a layer of analysis upon my analysis. I'm already evaluating what I think are the best assets to have now. And if you are on top of that evaluating, oh, is Jeppes' portfolio going to go up or down now? When should I add more? I should try to, then you're basically you're just adding an unnecessary extra layer of analysis on top. So when to add funds really depends on one's own financial situation. Some people like to add funds, once per year. For instance, after you've paid your final tax bill for the year or received some money back from the tax authority, and you can see how much cash you have, and maybe you have more cash than you really need. So that cash is available for investments. Maybe some people that make more in salary every month than they have in expenses, they like to invest the difference every month. It can also make sense to maybe do it every 3 months, every 6 months, to have some routine in it like that. In general, it's best to add at least $600 each time. So if, it can be better to add $600 every quarter instead of $200 every month. But at the end, you should only invest funds that you can afford to lose. If you have any, a credit card debt with a very high interest, it might be worthwhile to pay that off before. People that have that already know they have some big upcoming expenses might be better off saving or making a fixed deposit to meet those expense needs. if in general, when investing in stocks, it's best to have at least like a 5-year and ideally a 7-year higher time horizon for the investments. So it's not so good to invest money now that you think you'll need next week, because you'll just be paying the spread of going in and then the spread of going out for such a short time. It's really better to think of stocks as a long-term commitment and to invest at a steady pace in a time frame that suits your cash management. How concerned should we be about the US debt ceiling situation? So something like 75 times since 1950, or it's not exactly that, but that's how many times in a row the debt ceiling has been increased. So if something's been increased like 75 times in a row, what's the likelihood it's going to be increased the 76th time? Well, from just that information, it would seem pretty likely, but maybe there are some things this time around that makes it different. Are we really to an extent where some politicians would rather do massive damage to the country? We would do massive damage to the country just to make Biden look bad. I think that's not very sensible. I think this whole recurring debate over raising the US debt ceiling is not overall worthwhile. So instead of raising the debt ceiling to a fixed amount each time, we should change to a system where, for instance, it's increased automatically by 3.5% every year. Since 1990, the US debt has increased by on average 7% per year, a lot more in more recent years. So if you want to have this sort of like, you want to put a limit on how much the president can spend, you want to, ensure that there is some frugality, that, you're not just spending money left, right, and center and promising everything, then I think, but you also don't want to have, in a world where the norm is that the debt is increasing in somewhat proportion to the GDP, that you don't want to have this situation where you constantly have to make it a big deal that we are increasing the debt by an amount. So I think the sensible solution here is to agree on a fixed percent that will increase by year by year, and then come to a compromise based on that. And I think then, I still think it's very unlikely that we'll see the debt ceiling not be raised in this in this time around. And if it does happen, then, it's a bit of a chaotic situation. And I think that, there are certainly, I think, some companies that will see a sort of cash flow in their direction, and that makes them worth a little bit more. But it's not it's not a strong enough case that I think investors should take all of their money away from some companies and move them somewhere else. It's just sort of like, if a valuation already tells me that a company is a really good deal and this adds to it, it just slightly skew how much I want to have in this company. Oh, and finally on that, when I say that I think the debt should be increased by a fixed percentage every year, maybe some would argue it should be based on some, agreed economic variables. But the danger with that is sort of the whole debate on agreeing on those variables and how we track those variables. And sort of if you have something where you say like the debt has a limit based off of the GDP, then you could have a situation where the GDP declines a lot because of some crisis, and then also you suddenly got to reduce your debt at the same time, and that's just not necessarily the right time to do that. So you could, you will end up delivering a negative shock to the economy at a bad time, and so you don't want to pre-program that into the economic setup. So it's basically easier and safer and better for everybody, but generally good thing if we could just make the debt ceiling automatically grow by a fixed percentage. That was the questions that I received in advance. So thank you very much for those questions. And now I'll go through any questions from the chat. So if you have any questions, then please write them in the chat. All right. So for once, it seems like there are no questions in the chat. So in that case, we will end the call here. If you think of a question later, then you can always write a comment under my my posts on eToro, or write to me on LinkedIn, watch some of my YouTube videos. Yeah, thank you everybody for participating in this call. And yeah, I look forward to another hopefully exciting and profitable quarter.